Hmm. Very good morning, everyone. Now, everyone, those who are available in this live video, once again I will say you very good morning. Is the audio is audible? Everyone respond fast. Is it the sound is audible to everyone? Yes. Okay. So today we are starting the discussion of expected question. The expected question which I have already given you in PDF by way of PDF some days before. So we are now discussing the expected question from that PDF. Got it? Now if you have not downloaded the PDF of expected question, so you can download it from the link given in the description of this video. Now one question has been asked to me, so whether all the expected question whatever you have given for all the chapters, whether you will discuss. So of course I'll be starting with A category chapters, means all the chapters which are in A categories, all the expected question whichever I have given, I will discuss that. Now if you want any question, yeah, any chapter to be discussed separately, what you can do, you can comment in the comment box which chapter and which question you want me to discuss separately. So that will be also discussed. But once A category expected questions are discussed, then only I will take that chapter into consideration. Got it? Now it might happen there are some questions of this chapter, A category chapter, which I have not included in the PDF of expected question list, and you want me to discuss that question also. So what you can do, you can once again comment the question number either from my question bank, or you can give me the question number from Institute Study Matter RTP MTP. So that question also I will consider in this live video. Okay, got it? Have you understood this point? Correct? Now today we'll be starting with the one of the important chapter, that is share based payment. Normally a mandatory question will come from this chapter, and this chapter is very easy, but I have found a student do mistake in calculation only. Means I don't know why they do mistake, but I think from my point of view they don't read the question carefully, and because they don't read the question carefully they take wrong information from the question, and because they take wrong information, calculation of expense will be wrong, and even though now they are doing correct journal entry with wrong amount, the marks will not be given. So from my point of view, when you are reading the question, you should be very careful. Correct? Questions is easy, chapters is very simple. You need to be very much careful while calculating the EB expense in this chapter. However, I have taken some question which require attention, and because it require attention, discussion is required, and some question I have taken which may come in your exam. Similar question or same question may come in exam. Therefore, if you do this question before exam, then it will be beneficial for you. Correct? Understood? Got it. So can we start today? If you permit me, we can start. Are you all ready now? You can see I have given you 8 questions in this IND AS 102 as expected. Out of these question, from my point of view, questions should come. But it is quite possible in exam they are asking some different questions, so don't blame me. So this expected question you should not rely. It is my expectation which may be what? Which may or may not come. Normally when we estimate the amount of provision, so we say that actual amount may be different from provisional amount. Got it? Same thing here. This is only an expectation. There is a probability that the chances of these questions are more. but whether it will come, it will not come, that is known by ICAI only. Got it? Yes sir. So can we start? Yes sir. Come to question number 1, everyone. Question number 1, which is nothing but question number 5 of my question bank. So if you are using my question bank, then okay, you can say question 5 of what? My question bank. But if you are using ICAI study material or any other faculties question bank, then follow this PDF only. Got it? Yes sir. So can we start? Yes sir. So question number 1, Ankita Holding Incorporation grant 100 shares to each of his 500 employee on 1st Jan 2001, provided employee remain in service during the vesting period. The shares will vest at the end of first year if the company earning is more than 12%. Second year, if the company earning is more than 20% over the 2-year period. And third year, if the entity's earning increase by more than 22% over 3-year period. Means in this question, vesting period are not fixed. Can you say vesting period also depend upon the fulfillment of certain condition? So what they are saying, if first condition is satisfied, vesting period will 1 year. If second condition is satisfied, means if first condition not satisfied, then we'll go to second year. In second year, the condition given, if it is satisfied, then vesting period will be 2 year. If not satisfied, then we'll go to third year. And if in third year the condition whatever is given is satisfied, then vesting period will be 3 year. Otherwise, the entire option will be withdrawn. The fair value of 1 shares on grant date is rupees 122. But you can see this is fair value of 1 share. Correct? Normally when I have done this chapter in class, I said fair value of option is relevant, fair value of equity shares is not relevant for this chapter. So normally student misunderstood this fact कि fair value of shares and fair value of option are two different things. Now what is the meaning of fair value of option? Fair value of option is nothing but expected value of shares minus exercise price. Now if can I say exercise price is not given, so of course we'll assume exercise price to be 0. If exercise price of option is not given, so of course what is the assumption we need to take? The general assumption what we should take, that EP is 0. So in this case you can see EP is not given, so EP is equal to 0. And if EP is equal to 0, so can I say fair value of shares and fair value of options are same. So even though fair value of option is not given, but can I say it will be equal to fair value of shares in this particular question. In this particular question. Got it? Yes sir. In 2001, earning was 10% and 29 employees left the organization. The company expects that earning will continue at similar rate in 2002 and expect that shares will vest at the end of year 2002. So these are the information which is given for year 1. These are the information which is given for year 1. So what I will say, whenever you read question, draw a timeline. To avoid mistake in exam, normally student while reading the question they have understood, but while writing the answer they take wrong information from the question because they are very much, they read the question fast, they try to do the answer in very fast, and sometimes they take wrong information. To avoid that mistake, I will suggest, it is my suggestion, it is not compulsory but it is my suggestion, draw timeline. Draw timeline. Understood? Correct? You can see how many employee has been given for this 500 employee. Today is what? Grant date is what? 1/1/2001. Correct? What is the fair value of option? Of course we want fair value of option. In this case, in this question, fair value of shares given, but because EP is 0, the fair value of shares and fair value of options will be same. Are you getting what I am saying? 122. It is given. Correct. Now they have given the actual earning. Actual earning, A means what? Actual earning is 10%, and therefore condition is not satisfied for year 1. The vesting period will not be year 1. The vesting period can be either year 2 or year 3. Correct. Now they have given estimated earning. What they have given? Estimated earning. What they have said? The company expect the earning will continue at a similar rate in 2002. Expect that shares will vest at the end of year 2002. So they are saying expected earning will be more than the specified limit whatever is given the question, therefore condition will be satisfied. Then can I say estimated vesting period will be 2 year. Estimated vesting period will be 2 year. Now how many employee actually left? How many employee actually left? It is given in the question that actually left 29 employee. So employee left is equal to 29 employee, and how many employee they are expecting that it will leave in year 2. So year 2, how many employee they are expecting that 31 employee will leave the company. So can I say at the end of year 1 we are expecting that vesting period will be year 2, and as per the information given the question, it is estimated that how many employee will expect to vest the option at year 2. So it is given how much, 500 minus 29 minus 31, that is nothing but 440, and 440 is given in the question only. Understood? This is the information given for year 1. Got it? So company also expect that additional 31 employee will leave the organization in year 2002. It is given in the question. And 440 employee will receive their shares at the end of 2002. So these are the information given for year 1. Means as per this information, we'll calculate the expense of year 1. Now we'll come to year 2. Correct? So at the end of year 2002, the company's earning was now 18%. So company's earning was now 18%, but the condition is 20%. So once again, condition is not satisfied. Means for year 2, vesting period will not be 2 year. It will be either 3 year or option will be lapse, depending upon the information given the question. Yes, sir. So once again, can I say they have given for year 2, the actual earning is 18% over the 2 year. It means condition is not satisfied. Condition is not satisfied. Got it? Yes, sir. Now what they have given? Therefore, the share did not vest and only 29 employees left the organization during 2002. Now what is the employee left actually is what? How many employee? They have given only 29 employees. So once again, 29 employees left the organization. Actual number of employee. Got it? Yes, sir. Then what is given? Company believe that additional 23 employee will leave in 2003 and earning will further increase so that performance target will be achieved in 2003. The performance target will be achieved in 2003. So once again, how many employee will leave? 23. You can see employee left is now, the company believe that additional 23 employees. So at this year, they are believing that in year 3, 23 employee may leave. So how much employee now will be able to vest the option in year 3? These are all the information as given for year 2. Got it? So 500 minus 29 minus 29 minus 23. It becomes 419. 419 employee. This information have you understood? Yes, sir. Correct. Now they are saying that they will be able to perform the condition in year 3 as per the information given the question in 2003. Correct? It means, can I say for year 2 vesting period, estimated vesting period will be year 3. So you can add on estimated vesting period will be 3 year. Got it? Yes, sir. Now we'll come to what? Year 3. What happened in year 3? Let's see. At the end of year 3, only 21 employees have left the organization, and assume the company earning increase the desired level of performance target had been met. Means in year 3, condition has been satisfied. If condition is satisfied, means automatically the option vested in year 3. Correct. So but how many employee actually left? Employee actually left is 21. So now it become how much? 500 minus 29 minus 29 minus 21. So actual number employee who vest the option is 421. 421. Understood? And condition is satisfied in this year. So now based on this we recognize the expense. If you have understood this information, can I say this question is very easy, otherwise question is difficult. Otherwise question is difficult. Correct. Now we can calculate the expense. To write down calculation of EB expense. Correct. So what you will do? You will prepare one working note. You write on year end. Then write on working. The best way to do is in this way in exam. Then write on cumulative expense. Cumulative expense. Then write on expense. C means cumulative. Cumulative expense. Correct. Now year end. First year end is what? 31st December 2001. 2002, 2003. Correct. So how many employee you will take for year 1? Can I say 440 employee? Understood? So you can add on 440. 440 employee. Add on 440 employee. 1 minute. So 440 employee. Got it? Any doubt? No doubt. And how many option per employee? It is given 100 share, so into 100. What is the fair value? It is 122. Can you say for the first year the vesting period was 2 year, that was estimated, so you will do 1 by 2. So how many cumulative, what is the cumulative expense? 440 into 100 into 120 divided by 2 you will do. It is coming how much? 26 lakh 84,000. So this will become the expense of first year. Why it will become expense for the first year? Because this is the cumulative expense of 1 year only, and we are calculating expense of first year only. Got it? The second year the number of employee will change. Now as per our calculation, number of employee estimated who can vest the option in third year is 419. We will take 419. We will start doing reassessment of expense. It will remain 100 only. It will become 122. And now the estimated vesting period for second year is 3 year. So we will do 2 by 3. It is, we are now calculating cumulative expense of 2 year. So now what is the calculation? 419 into 100 into 122 into 2 divided by 3. It is coming how much? It is coming 34 lakh 7,867. From this will minus this. How much it will come? 26 lakh 84,000. It is coming how much? 7 lakh 23,867. This become expense of second year. Now last year, last will take actual employee. Actual employee is 421. As per our calculation, you can see actual employee is 421. Got it? Into what? Into 100 into 122 into what? 3 by 3. So now we'll take 3 by 3 because our actual vesting period is 3 year. Got it? It will become 421 into 100 into 122 is equal to how much? It is 51 lakh 36,200. From this will minus this, so we'll get expense of third year. Got it? So it is minus what? Minus 34 lakh 7,867. How much it is coming? It is nothing but 17 lakh 28,333. Got it? Once you calculated correct expense, now journal entry is very easy. Journal entry will what? SBP, EB expense account debit to SBP reserve for every year. And they have asked only what? Journal entry for 3 years. Means they have not given the information that how many employees actually exercise the option. So you can assume that all employees exercise the option. So at the end you can pass SBP reserve account debit to equity. Got it? That same journal entry has been given. Check karenge. You can see EB expense to SBP reserve, EB expense to SBP reserve, EB expense to SBP reserve, and you can see the last, it has been assumed that all employees exercise the option. It is not given the question, but they have taken one assumption, SBP reserve to share capital, because nominal value of the shares has not been given. You can see nominal value has not been given for the share. Therefore, entire amount has been transferred to equity share capital. Got it? Correct. If nominal value has been given, then you can say this amount is capital and this amount is premium. Got it? Simple. Yes, sir. Question number 1 understood. Let's come to question number 2. Question number 2 is a question which is a question related to SBP with cash alternative. Normally this type of question they ask in exam. SBP with cash alternative, important question. Tata Industry has issued a share based option to one of its key management personnel which can be exercised either in cash or equity, and it has the following features. You can see cash settled shares is 74,000. Service condition is 3 year. Option number 2 means this was option number 1. Option number 2 is equity settled shares 90,000. Condition. There is a service condition of 3 year. There is a restriction to sale. Okay, restriction to sale will be for equity settlement. So even the question has not given, it is always for equity shares. It cannot be for cash settlement. Equity shares. So restriction to sale is for 2 year. Means once the equity shares has been allotted because you opted for equity settlement, then there is a restriction for 2 year that you cannot sell the equity shares to any other party. Then fair value has been given. You can see fair value equity price with a restriction of sale for 2 year is 115. So it is the fair value of equity shares. It is the fair value of equity shares with restriction. Once again, can I say in this question EP exercise price is 0? Once again, whenever exercise price is 0, so once again I just want to say कि fair value of equity shares and fair value of options will be same. But whenever exercise price is given, fair value of equity shares and fair value of options are different. This you need to be careful. Normally students do not understand this point. You can see equity shares, they have given fair value, thank you very much. So this become fair value of option. Can I say this become fair value of option with restriction? Now they have given fair value of on grant date. If nothing is given, so can I say this will be without restriction? Means this is for cash settlement and they have given fair value. Nothing has given. So this is also without restriction. 138, 140, 147 at the end of each year. Means for the first year, second year, third year they have given. So we all know that for cash settlement, reassessment of fair value of option is required. But for equity settlement, we never do reassessment of fair value of option to calculate EV expense. This point have you understood? Correct. Now how to calculate expense and what will be the required journal entries? Correct? Yes, sir. Means once again, I will just like to explain you a timeline. This is a question. Question is for how many year? 3 year. Now option has been given. The first is cash settlement. Now in cash settlement, how many equity shares they have given? It is 74,000 equity shares. Correct? And there is a service condition of 3 year. Got it? Yes, sir. Now in this case, they can say fair value of option for cash settlement. It is given how much? 135. Then it is given how much? 138. Then it is given how much? 140. Then it is given 147. Correct? So whenever it is given fair value and nothing is given, it is fair value without restriction. It is fair value without restriction. Got it? Now, can I say then we have equity settlement. In equity settlement, they have given how many equity shares? 90,000. 90,000. Normally they will also give exercise price, but if exercise price is not given, it will be assumed to be 0. It will be assumed to be 0. Correct? Now there is a restriction to sale, so therefore we want fair value without fair value with restriction, and it is given fair value with restriction. How much given? It is given how much? You can see it is given 115. And you can see they have not given this information. Means they have not given fair value with restriction at the end of each year. However, can I say this is not required also? Means if in exam they have given this, please ignore this. If in exam they have given this, please ignore this. Correct? Got it? These are the information given. Can we do it? Yes, sir, we can do it. So let us start. In this, what we'll do? First, we'll calculate. Write down. First, we'll find out how much is the liability component and equity component on grant date. Means can I say on grant date, we don't know whether employee will opt for cash settlement or employee will opt for equity settlement. Therefore, what India says that first you calculate maximum liability and whatever amount left, that will become equity. Correct? So what we'll do, just write down calculation of fair value of liability component. LC means what? Liability component and equity component on which day? On grant day. On grant day. Correct? Got it? This point have understood? So grant date means at the beginning of the contract? Yes, sir. So what we'll do? First we'll calculate fair value of liability component. This will be the maximum liability. So how many shares it is given? 74,000 into 135 will do? 74,000 into 135. So we'll do 74,000 into 135 is equal to how much? 74,000 into 135 is coming how much? 99,90,000. 99,90,000. Correct? Yes, sir. Got it? This become maximum liability on grant date. Means all the employee opt cash settlement on grant date. Token is this is the amount of cash which need to be paid. Yes, sir. Now we'll find out fair value of equity component. Fair value of equity component. So fair value of equity component. First we'll find out what will be the fair value of equity settlement on grant date. So can I say it will be based on 90,000 shares? 90,000 and the fair value of option is nothing but 115. So this become maximum equity. So what is the maximum equity? You can see 90,000 into 115 is equal to how much? It is how much? It is 1 crore 3 lakh 50,000, so it become 1 crore 3 lakh 50,000. But out of this already we are considering how much liability, means this much liability we are considering maximum liability on granted. So balance will be considered as what? Equity component. Balance will be considered as equity component. So 90,000. How much it is coming? So 1035 minus 999 is equal to how much? It become how much lakhs? You can see 36 lakhs. चलेगा? बोलो. Sorry, 3,60,000. 3,60,000. Understood? Have you understood this point? Now, can I say the liability component will be considered as cash settlement? Means whatever we used to do for SAR, remember stock appreciation, right? That will be applicable for liability component, and equity component is nothing but equity settlement. So whatever you used to do for ESOP, that will be applicable for what? Equity component. Correct? Means can I say this equity component, the fair value will not be reassessed every year, but liability component fair value will be reassessed at the end of each year. Got it? So now we'll do calculation of EB expense. Calculation of EB expense. We'll find out calculation of EB expense. Can we do it? Yes sir, we can do it. We will do year 1, year end, working, then cumulative expense, then expense. Got it? Yes sir. Yes sir. We'll start with first year 1. So first we'll do for liability component. The liability component. Can I say liability component is for how many equity shares? 74,000. But now the fair value has been changed at the end of the first year. So now fair value has become 138. So you will do reassessment of this and you will do 1 by 3. Correct. How much it is coming? 74,000 into 138 divided by 3. It is coming how much? It is 34 lakh 4,000. Correct. Same thing you will do for equity component. Now equity component is 90,000. Correct. 90,000. Just try to understand. So can this become fair value of equity component, which will not be reassessed, but it can change if there is some changes in the number of options, because in this question number of options remain same throughout the vesting period. So you can say 3,60,000 divided by 2, but can number of options may change due to what? Due to if any employee leave the company during the period of vesting period, during vesting period. So in this question, because no information have been given about the employee left, so we'll assume that all employee will able to perform service condition during these 3 years. I hope you are understanding. So what we'll do, we can do in this way: 3,60,000 divided by 90,000. So this become what? We can say the fair value of equity component per option is equal to 4, and this will not change. Means this number of equity shares may change due to what? Changes in the number of employee. However, in this question the number of employee remains same. So you can directly do 3,60,000 divided by 3. But can I say in your exam question it is quite possible they have said that this much employee has left in first year, this much employee will leave in second year. Then you can't say 3,60,000 divided by 3. Are you getting what I am saying? So what we'll do from exam point of view to avoid such type of mistake, we'll write down 90,000 separately and 4 separately. And then we'll do 1 by 3. It is nothing but it will come out as 90,000 into 4 divided by 3 is nothing but 1,20,000 every year. Got it? And expense will remain same, 34 lakh 4,000. Correct? 34 lakh 4,000. And this will be 1,20,000. You can total it if you want to total. It will be 34 lakh 4,000. This is coming how much? 35 lakh 24,000. This is the expense of first year. Now you can continue. Year 2. Liability component. Can I say once again it will be 74,000, and now the fair value has been changed from 138 to 140. So we'll do what? 2 by 3. Correct. So 74,000 into 140 into 2 divided by 3 is coming how much? Can I say it is coming 69 lakh? Are you able to understand? It is coming how much? 69 lakh 6,667 minus what this will do? Minus. So minus 34 lakh 4,000. This will come how much? 35 lakh for the second year, correct? Bolo. It will be 35 lakh 2,667 and equity component will be 90,000 into 4 into what? 2 by 3. So it will be 2,40,000 and 2,40,000 minus 1,20,000. It will be 1,20,000 only. So what is the EB expense? EB expense become how much? 35,04,667 plus 1,20,000. It is coming how much? 36,22,667. Got it? Year 3. Can I see year 3 you can do now? Liability component, once again it will be 74,000 into what? Now once again there will be reassessment of fair value, that is 147 into what? 3 by 3 you will do. So how much it is coming? 74,000 into 147. Correct. It is how much? 1 crore 87 means 1 crore 8,78,000. 1 crore 8,78,000 minus what? Minus 69,06,667 is equal to how much? It is 39,71,333. Correct? And equity component, it will remain same. It will be 2,40,000 and this will be 1,20,000. So total expense become how much? This is plus 1,20,000. This is how much? 40,91,333. This become calculation of EV expense. Means if you have done mistake in this, so can I say game is over? If you have done mistake in this, so game is over now. So be careful about this. Now you can pass journal entry. Here the first journal entry will be EB expense to SBP liability to SBP reserve. Then second year once again EB expense to SBP liability to SBP reserve. Then third year also EB expense to SBP liability to SBP reserve. Means first year, second year, third year journal entry will be very easy. Only now I need to explain the journal entry on settlement date. Means normally student do mistake the settlement journal entry. Correct? So I'll just give you the journal entry on settlement. On settlement. Now even the question is silent because question has not given whether employee will opt for cash settlement or employee will opt for equity settlement. So we'll give you both the case. Means you need to give you the both the case. Here on settlement, if employee opt for cash settlement, then what will be journal entry? Correct? So cash settlement means, can I say the liability will be settled. The first journal entry will be what? SBP liability account. SBP liability account with cumulative expense, that is nothing but this amount. Bole yes or no? We will say 1 crore 8,78,000 to bank. This journal entry. And then whatever SBP reserve will remain in equity only. So when I am saying SBP reserve, that account will now close and that will remain in equity. So you can transfer to any other equity, but as per ICAI solution, will transfer to retained earning. Will transfer to retained earning. What is the amount? That is what? Sorry, this will be 3,60,000. My mistake. 3,60,000. So can I say it will be 3,60,000? Have you understood this? Bolo. Yes, sir. This point have you understood? Now, coming to equity settlement means either this or this. Coming to equity settlement. Now, equity settlement, you need to just settle the liability by allotment of equity shares. So what journal entry will do? SBP liability will be now converted into equity shares. 1 crore 8,78,000. There is no exercise price. So nothing will be received from employee. I'm just writing bank account debit. If there is some exercise price, so that amount will be received. Correct? To what? To equity share capital and to securities premium. So how many shares? It is 90,000 shares. We'll assume that the nominal value of shares is 100. So it will become 90 lakh, and balance will be transferred to securities premium, that is 18 lakh 78,000. Got it? And once again, SBP reserve will remain in equity only. This will be SBP reserve will be closed and transferred to retained earning. This is as per ICAI solution. You can also transfer to any other equity also. Correct now? So it is not so that you need to always transfer this to retained earning. You can transfer to any other reserve also. Got it? So this is 3,60,000. Have you understood this question number 2? Question number 2 you have understood? Bol. Done? Yes, sir. So question number 2, one question I have taken for what? SBP with cash alternative. Let us come to next question. Question 14. Question 14 of my question bank and question number 3 of expected question. Now this is also very important question. Already asked 2 times in exam. Normally students do mistake in this question. This is a question related to SAR. But only one point I have seen student do mistake. What they have said, Minda issued 11,000 share appreciation right that vest immediately. When they say that vest immediately, so can I say entire expense will be recognized on grant day only, because grant day and vesting day are same. So in this question the special point is that the option become vested on grant day only. So grant day and vesting day are same, means entire expense of that option will be recognized on grant day or on vesting day, whatever you want to say. This imply on 1st April 2000 SAR will be settled in cash using an option pricing model. At that date it is estimated the fair value of SAR is rupees 100. SAR can be exercised at any time until 31st March 2003. So exercise period is 3 years. At the end of period 1 it is expected exercise the option 95% of the total employee, means 95% of total employee may exercise the option, then 92% at the end of next year, and finally it was vested. It should not be vested, it should be exercised, means there is some clerical mistake in question only given by ICAI. So you can see it was exercised. Same question can be asked in exam, same question there will be some typo mistake, but ignore it. It was exercised only by 89% of the employee at the end of third year. You can see value of SAR is given at the beginning, means they have given at the end of first year, at the end of second year, at the end of third year. On grant day it was rupees 100. Got it? Yes, sir. So in this what we'll do, just write down, we are doing question number 3 of expected question. So can I say we need to recognize entire expense at the beginning of first year only, means on start. So if I will say year 1 beginning, how much expense will be recognized? How many options has been given? 11,000. What is the fair value of option at the beginning? 100. And this will be total expense to be recognized, means total expense, cumulative expense will be 11 lakh, and 11 lakh will be recognized as an expense immediately. Normally students do mistake only, they will do 1 by 3 because they are habituated of doing that. So here vesting period is 1 day, however exercise period is 3 years. Now in exercise period we'll do reassessment. Correct? So year 1 end, you can see year 1 may end, the information of fair value has been changed. So now it become 132. So it become how much? Batao. Correct. So initially if nothing is given, we'll always assume 100% will be exercised. Then at year end 1 it is given how many employee will exercise the option. They have given how many, what is the percentage? 95%. Correct. So now it become 11,000 into 132 into 95%. It become how much? 13 lakh 79,400 minus what? 11 lakh. So it is what? Expense at year end 1, 2,79,400. So we'll increase the expense. Now we'll come to year 2 end. Once again it will be 11,000. What is the fair value? Fair value is now how much? 139. And now how many employee is expected to exercise the option? 92% employee. Got it? So it become 11,000 into 139 into 92%. How much it is coming? Cumulative expense 14 lakh 6,680. But out of that, how much already recognized? 13 lakh 79,400. That is equal to how much? 27,280. Got it? Yes, sir. Now year 3 end, once again information has been changed. Now they have given actual information ki how many employees actually exercise the option. 89%. So the but fair value has been changed. It become 41. So it become into 89%. So it is 11,000 into 89%. 11,000 into 141 into 89%. You can do. It is coming 13 lakh 80,000. 390. You can see expense reduce. So now it is what? 26,290. 26,290. Correct now. So minus 14,06,680. It is 26,290. 26,290. But it become negative. So this is the reduction of expense. Now in case of SBP liability, in case of SAR, whatever difference is coming due to reassessment liability will be always transferred to PL. Always transferred to PL. Even though it is during exercise period. Even though it is during exercise period. I hope you are understanding. Correct now. Normally in case of equity settle, if during exercise period the vested options is cancelled, then we transfer SBP reserve to retained earning, not to PL. As we have done in the last question, you can see this has been transferred retained earning. So equity always remain in equity, but liability, the reassessment will be always transferred to PL, even though this is during what? Exercise period. Here also student do mistake कि they transfer to retained earning. That is not correct. Got it? So the journal entry is very simple. First day EB expense debit to SBP liability, then EB expense debit to SBP liability, then EB expense to SBP liability. Here SBP liability to EB expense, and then SBP liability will paid SBP liability account debit to bank. Got it? Same journal entry is given. Check karo. Yes sir? Correct. Understood? Can we take one more question? Now question number 4 is a question of group SBB plan. So I'm expecting one question from this because they have given a good question in ICAI study material, but till now they have not asked this type of questions. Karina, group SBB plan, what they have given? A parent company P grant 30 share to 100 employee, each of its subsidiary company S on the condition that employee remain employed by company S for 3 years. Assume that at the outset and at the end of year 1 and year 2, it is expected that all employee will remain employed for all the 3 years. Means no employee will leave the company, means all the options will remain vested. At the end of year 3, none of the employee has actually left. The fair value of shares on grant date is 5 per share. Company has agreed to reimburse company P over the term of arrangement for 75% of final expense recognized by the company S. What would be the accounting treatment in the company P and company S? Got it? Now in this question, you can see question number 4 we are doing. Correct. The question of what? Group SBB plan means there was one subsidiary company, there is one parent company, there is employee of subsidiary company. So employee is providing services to subsidiary company, but who will allot equity shares? Equity shares will be given by parent company. So this type of question is known as group share based payment plan. So of course can I say the transaction, this SBB transaction is settled by parent company on behalf of subsidiary company. Correct? Therefore it is quite possible that subsidiary company may pay some amount to this parent company. So what they are saying is 75% of total expense will be reimbursed by subsidiary company to parent company. So 75% will be settled in cash, but balance 25% will be what? SBP transaction. Whatever settled in cash, that is not SBP transaction. Whatever not settled in cash, so that is settled either in the form of equity shares or either in the form of cash based on the price of equity shares. So this 25% will be what? SBP transaction. I got? Yes? Have you understood? Got it? Yes sir, we have understood. Have you understood this point? So what will be journal entry? Now in this case, just try to understand. In this case, in the books of parent company, in the books of subsidiary company, what will be journal entry? In the books of parent company, journal entry will be investment account debit. Investment in equity instrument of subsidiary company, account debit. Bank account debit because some amount is already received. To what? SBP reserve every year. This is the journal entry. In the books of subsidiary company, it will be what? Bolo. Are you able to understand this journal entry? In the books of subsidiary company, it will be EB expense, out of which some amount will be paid to what? Parent company, and some amount which will not be paid to parent company. It is just like capital contribution from parent company. It will be just like capital contribution from parent company. Understood? Correct? This is journal entry. Now every year you need to find out what is the amount of SBP reserve or EB expense, the total EB expense or total SBP reserve. That will depend upon the information given in the question. So they have said how many employee? 100 employee. How many options per employee? 30. What is the fair value of option on granted? 5. And we'll do 1 by 3. It is coming 100 into 30 into 5 divided by 3. So 5,000. Out of this 5,000, 75% will be reimbursed. So 75% is how much? Is equal to 3750, and 25% will be how much? 1250. So investment will be 1250. Amount received will be 3750. Total SBP reserve will be 5,000. Same thing here also. EB expense will be 5,000. What is the amount paid is 3750, and capital contribution will be 1250. Simple now. Got it? Have you understood? Can I say every year this journal entry will be repeated? So you can pass the same journal entry every year, year 1, year 2, year 3. That is only given. You can read the solution given. Correct now? Got it. But have you understood this point? Simple. So this question may be expected in exam for 5 marks. Till now this question has not been asked in exam. Got it? Any doubt? No doubt? Yes, sir. Then let us come to the next point. Next question. Question number 5. Can we come to question 5? This is also very good question. I like this question personally. One second question related to SAR. Correct now. But very good question. What they are saying? Entity which follow his financial year as per calendar year grant 1000 share appreciation right to each of his 40 management employee as on 1st Jan 2005. Correct? The SAR provide the employee with the right to receive at a date when the rights are exercised the cash equal to appreciation in the entity share price since the grant date. Means this is question related to SAR cash settled SBP. All of the right vest on 31st December 2006, means vesting period is 2 years, and they can be exercised during 2007-2008. to exercise period is 2 years. Management estimate that at grant date the fair value of SAR is 11, and it estimated overall 10% employee will leave during that 2-year period. So it is estimated that during vesting period overall 10% employee may leave the company. The fair value SAR at the end of each year is given. You can see at the end of each year means 2 vesting period and 2 exercise period to 4 years. So at the end of each year they have given fair value. Yes sir. Yes sir. 10% employee left before the end of 2006. So estimation was also 10%. Actually also 10% employee left. Okay sir. On 31st December 2007, when the intrinsic value of SAR was 10, 6 employees exercised their option, and remaining 30 employees exercised their option at the end of 2008 when the intrinsic value of SAR was equal to fair value 12. How much expense and liability will be recognized at the end of each year? Past journal entry. Good question. Very good question. Can we do it? So this is question number 5 of expected question. Question number 5. Correct. So what is the question? Let me first draw the timeline. You should draw timeline by your own. What is given? You can see 1 year, 2 year, 3 year, 4 year. How many year? 4 year. So it was started on which date? On 1/1/2005. On 1/1/2005. How many employees given? It is given how many employee? 40 management employee. how many options per employee? 1000 shares has been given. Correct. What is the fair value of option on grant date? So fair value of option on grant date, it is not given, not required also, because it is SA. So fair value of option on grant date is not required. How it is given? Fair value, the management estimated at grant date fair value is 11, but this is not at all relevant. Not at all relevant. Now fair value at the end of each year is 12, 8, 13 and 12. Now they have given intrinsic value also. Intrinsic value they have given at the end, means on 31st December 2007. So this is 31st December 2005. This is 6. This is 7. This is 8. Correct. So intrinsic value how much given? It is given how much? 10. And then on this date it is equal to fair value. Now what is the difference between fair value? Fair value is an estimation. Estimation of means estimation ki at what price it will be exercised. Means the option which is already exercised, for that will use intrinsic value. So I will say this is the intrinsic value. Intrinsic value is nothing but market price as on this date minus what exercise price, but this is the expected intrinsic value. This is what expected intrinsic value. So can I say expected intrinsic value will be used for valuation purpose, but for payment will use intrinsic value. Now this is the difference. Difference, have you understood? Intrinsic value and fair value. I hope you have understood. Correct. Now they have given during this period overall it was estimated 10% employee will leave, and actually also 10% employee has left at the end of 2006. This information is also given. I think all information we have written. Correct. Yes. So now we can start. So we'll start what? The calculation of EB expense to year end. Then we write down working. Then we write down cumulative expense. Then we write down expense. And in this question, because they have also asked liability at the end of each year, therefore we'll also have one more column about liability. Chalega? Yes, sir. So we start with the first year, 31st December 2005. So how many employee? 40. Out of that, how many employees expected to leave? 10%. Means how many employee will retain? 90%. So we'll do 40 into 90% into what is the options per employee? 1000. What is the fair value? So we'll take 11 or 12? We'll take 12. So we'll not take fair value on grant date. This is also point where a student can do mistake. You will take into 12, not what? Into 11. Into 1 by 2 or 1 by 4? Here also this is 4-year total contractual life, but vesting period is 2 year only. So you will do 1 by 2. You will not do 1 by 4. Are you getting? So here also you can do mistake if you do not understand the emotions of the question. Got it? This is the calculation. Have you understood the calculation part? Have you understood the calculation part? Bolo. Yes, sir. So how much it become? 40 into 90% is 36 into 1000. Acha, fair value I have not written. Na? Into 12 I have not written. Into 12 also. Into 12 into 1 by 2. So into 12 divided by 2 is equal to how much? 2,16,000. This become cumulative expense. This only will become expense, and this will be the liability of first year at the end of first year. Now I'll come to the second year, 31st December 2005, and actually also 10% employee left. So 40 minus 10% means 36. So we'll take 36 employee into 1000, but we'll now do reassessment based on the current fair value. Now current fair value is 8. So we'll do what? Into 8. Now into 2 by 2 to calculate cumulative expense. So 36 into 1000 into 8 divided by into 2 by 2. It is how much? 2,88,000. Out of 2,88,000, how much already we have recognized as an expense? So 288 minus 216 is equal to what? 72,000. And the liability at the end of second year will be 2,88,000. Got it? Because nothing has been paid. Payment will be done during exercise period. Got it? Yes, sir. Now I'll come to what? Exercise period 31st December 2006. Now in this, yes, 6 employees have exercised and 30 employees have not exercised. So for 6 employees, can I say payment will be done based on intrinsic value? Payment will be done based on intrinsic value. Intrinsic value is how much? It is 10. Understood? And for 30 employees, valuation will be done based on what? Fair value. This is the difference. Correct now. So into 13 we'll do. Have you understood this point? This become total expense, cumulative expense for 3 years. Have you understood? For 6 employee, the payment has been done based on intrinsic value, but for remaining employee, valuation will be done based on fair value of option. This point, are you able to understand? Yes, sir. It will be 6 into 1000 into 10 means 60, and 30 into 1000 into 13. It is 3 lakh 90. 3 lakh 90 plus 60. Correct now? Correct? 1 minute. It is coming how much? 3,90,000 plus 60,000 means 4,50,000. Out of 4,50,000, how much expense already we have recognized? That is this much. So what is the expense? Expense will be 1,60,000. Correct? And can I say liability out of 4,50,000 already we paid 60,000 because that is paid at the end of third year only. So 4,50,000 minus 60. So what is the liability at the end of third year? That is only for 30 employee. That is 3. That is what? That is what? How many employee? 30 employee. Got it? Have you understood this calculation? I hope you are understanding. Then last 31st December 2007. Now 30 employee will be paid based on the intrinsic value. And can I say at the end both fair value and intrinsic value will be always same. So at the end of the contractual life, intrinsic value and fair value will be always same. So if intrinsic value is not given, so always will take fair value for payment purpose. Got it? Yes, sir. It is now 30 employee into 1000 into what? How much? 12. It is coming how much? 30 into 1000 into 12. That is 3,60,000. But now comparison will be done with what? For 30 employees. For 30 employees, the last year expense was 3,90,000, which now become 3,60,000. So there is a reduction of expense, that is 30,000. We reverse the expense to the extent 30,000 and the liability will become 0. Have you understood this calculation? Now, journal entry is very simple. Journal entry will have first journal entry EB expense debit to SBP liability with this amount. Then EB expense debit to SBP liability with this amount. Then EB expense to SBP liability with this amount. Then in this year only SBP liability to bank with 60,000 also. Got it? We need to pay also. Then last first there is the reduction of expense. The SBP liability to EB expense. We reduce liability, then paid SBP liability to bank. How much? 3,60,000. This journal entry will do. The journal entry for SAR is very simple. Only you can do mistake in calculation of expense. That you need to be very much careful. In this you need to be very much careful. Got it? Any doubt? Are you able to understand? Bolo. Have you understood this? Yes, sir. Chalo. Now, let us come to the next question. Come to question number 6. This question is newly inserted, till now not asked. Normally, what is grant date, what is measurement date? Correct? Now, grant date means normally there are two type of SBP transaction we have done. One is employee SBP, means employee based SBP transaction. One is non-employee based SBP transaction. Now, whenever we have done contract with employee, then grant date and measurement date are same. Means grant date and measurement date will be same. What is grant date? When the agreement has been entered. So grant date and measurement date means when the fair value of option will be measured. So that will be same. But in case of non-employee, the grant date will be the agreement date, but measurement date will be date when the control of the goods has been obtained or services has been received. This is the difference. Difference, have you understood? So in this question you need to find out what is the grant date and measurement date based on the following transaction. Let us read one by one. On 1st April 2001, New Age Technology Limited decided to grant share option to its employee. The scheme was approved by the employee on 30th June. So again 30th June will be only the grant date. Are you getting? 30th June will be the grant date. New Age Technology Limited determined that fair value of share option to be valued will be the value of equity shares on 1st April 2001. So they are saying the fair value will be the based on the fair value of shares on 1st April 2001. This is not correct. So can I say, in this case, you can see the grant date and measurement date will be same. So grant date is also 30th June and measurement date is also the same. Got it? So grant date and measurement date will be same. Therefore, the whatever management want, that is not correct. Now come to the second point. On 1st April 2001, New Age Technology Limited intend to contract to purchase IT equipment from Bombay Software Limited. So, is non-employee SBP transaction. And agreed that contract will be settled by issuing instrument of New Age. So, grant date is 1st April 2001 because agreement has been entered. New Age Technology Limited received the IT equipment on 30th July. So, this is the date when the control is obtained. Therefore, measurement date will be 30th July. Measurement date is 30th July. Understood? Have you understood this point? 30th July? Correct. So in this case you can see 30th July will be the measurement date, but grant date will be 1st April. Check karo. The agreement was entered on 1st April, but measurement date will be 30th July. Correct. In first question you may have, first case you may have doubt, sir. On 1st April, New Age Technology Limited decided to grant. They have decided agreement will be entered when the employee has approved it. So you can see the scheme was approved by the employee on 30th June. So approval date, once the offer is accepted, then only the contract has been entered. Now, so you have decided to enter, it does not mean the contract has been entered. The first case, 30th June was the contract date. Got it? Third. On 1st April 2001, the New Age Technology Limited decided to grant the share option to its employee. The scheme was approved by the employee on 30th June. The issue of the share option was, however, subject to same being approved by the shareholders. So can I say in this case shareholders approval is also required, and the scheme was approved in the general meeting held on 30th September. So again 30th September become the grant date as well as measurement date, because this is employee share based payment date. Because this is employee share based payment transaction, so grant date and measurement date will be same for employee share based payment. Last. You can see 1, 2, 3, 3 has been given. Have you understood this all? Correct. If you read the answer, just try to understand what they have given. Grant date. The date at which entity and another party agreed to share-based payment arrangement, being when the entity and the counterparty have shared understanding of the terms and conditions of the arrangement. Measurement date. The date at which the fair value of equity instrument granted is measured for the purpose of this index. For transaction with employee and other providing similar services, the measurement date is grant date. For transaction with party other than employee, the measurement date is the date when the entity obtained the goods or counterparty rendered services. This only I have said. Correct. So this question is not yet asked, can be asked in exam. Therefore, I inserted in expected list. Correct now. Good question for 5 marks question. This can be asked. Yes, sir. Next question. This also, I like this question. This is a question of modification. I like this question personally. Therefore, I have taken and expected also. QA Limited had on 1st April 2015 granted 1000 share option to each of its 2000 employees. The options are due to vest on 31st March 2018, provided the employee remain in employment till 31st March 2018. Okay. Means, can I say the vesting period is 3 years? On 1st April 2015, the directors of a company estimated that 1,800 employees would qualify for the option on 31st March 2018. Let us draw the timeline, because this question has many information. If you will not draw, you will be confused. Question number 7. Chalega? So can we start drawing timeline? Yes, sir. They have given the grant date is what? 1st April 2015. So on 1st April 2015, how many employees are there? 2000 employees are there. How many option has been given per employee? 1000 option has been given per employee, and it will be vested at the end of 3rd year, 31st March 2016, then 17, then it is 18. Okay, sir. Then on 1st April 2015, the director of the company estimated. So they have estimated how many employee will vest the option 1800 on grant date. Correct. This much we have read till now. Then what is given? The estimate was amended to 1850 employee on 31st March 2016 and further amended to 1840 employee on 31st March 2017. So this estimation was amended. So on this date it become how many employee? 1850. On this date how many employee? It become how much? 1840. Correct? Got it. Yes, sir. Then what is given? On 1st April 2015, the fair value of option is 1.20. The fair value increased to 1.30 as on 31st March 2016. But due to challenging business condition, the fair value declined thereafter. So what is the fair value has been given for the option? The fair value has been given for the original option. How much given? It is given on grant date. It is 1.20. And at the end of first year, it is 1.30. Got it? Yes, sir. In September 2016, when the fair value of an option was 0.90, the director repriced the option modification and this caused the fair value to increase to 1.05. So, can I say on 30th September, something happened on September? The fair value was 0.90 and because of modification, now for modified plan, the fair value become 1.05, 1.05. This point have you understood? Yes, sir. So this is the fair value of modified plan. This is the fair value of modified plan. Correct? Yes, sir. This is the fair value of modified plan. Yes, sir. Then trading condition improve in the second half of the year and by 31st March 2017 the fair value of option was 1.25. So now the fair value option, so of course now we'll take modified only, so it become 1.25, 1.25. Yes, sir. Correct. UL Limited decided that additional cost incurred due to repricing of the option on 30th September 2016 should be spread over remaining vesting period from this date to this date. Even though not given, we'll do this only because there is a concept of modification. I will explain you this first. Just try to understand. In this question, 3 points are relevant. Whenever there is a modification, so we'll find out incremental fair value of option. Incremental fair value of option means fair value of modified plan on the date of modification minus fair value of original plan on the date of modification. Means this will be compared because this is the date of modification. This is the modification date now. So this become how much? 1.05 minus 0.90 means 0.15. And because of this incremental fair value of option, some expenses will be increased for which benefit will be received during remaining vesting period. So this will be spread over remaining vesting period, means from 30th September to 31st March 2018. That is given the question, but even though not given, we'll do that only. Correct. Now, because this is equity settled, so we'll never do reassessment of original plan. So for original plan, we'll take 1.20 and this information is not at all relevant. This information is not at all relevant. Correct. Understood. So we need to understand which information is not relevant. Now we can calculate EB expense. Now in this question they have asked only expense to calculate. We need to calculate expense only for first year and second year because they have not given any information for third year. Provided if they have given the information third year, we can also calculate the expense of third year and pass respective journal entry. Yes, sir. So we'll do only expense calculation for first year and second year. So first year 31st March 2016. Correct. Now always we'll calculate for original plan and modified plan. First year there is no modification, so only original plan will take. OP means original plan. How many employee? This employee is not at all important. We'll take employee estimation at the end of first year. At the end of first year, because we calculate expense at the end of first year. So we'll take 1850 employee. It is 1850 employee. Number of option is 1000. Fair value is 1.20. We'll do 1.1 by 3. So 1850 into 1000 into 1.2 divide by 3. Coming how much? 7,40,000. Got it now? समझ रहे हो ना? 7,40,000. First year is very easy. Second year, 31st March 2017. In the original plan, the expense will remain same. As means for original plan, you are not going to change the fair value option. You need to recognize expense as you have done before. Correct? So now the number of employee will change 1840. We will take 1840 into what? 1000 and the fair value will remain same 1.20. We'll do 2 by 3. Plus, but there is some additional expense. So additional expense will be for 1840 employee, the 1000 option, but additional expense will be 0.15, and this will be spread for how many year? 1.5 year, means zero point 0.5 this year, half year this year, full year third year. We will do 0.5 divide by what? 1.5. Understood? It will be 1840 into 1000 into 1.2 into 2 by 3. It's coming how much? 14,72,000. And this is what? 1840 into 1000 into 0.15, 0.5 divided by 1.5. It is coming 92,000. Total become what? 14,72,000. It become 15,64,000. Minus 7,40,000, so minus 7,40,000 you'll do. It become 8,24,000. Understood? This is the expense of second year. But this calculation you need to understand. And what are the information which is not important? Normally you can see they have given this bakwas information, this bakwas information, this bakwas information. So normally students are confused with the bakwas information. Got it? If you have understood the concept, you can do easily. Correct? So this also question number 7 also you have understood. Now let us come to the last question. Last question of my expected list. This question is also ICAI study matrix question, but till now not tax, but can be a good question from exam point of view. Correct? Question 14. Entity P issued share-based payment to its employee based on the following details. Number of employee 100, fair value on grant date INR 25, market condition share price to reach INR 30. Now whenever there is some market condition, so due to market condition, the number of options will never change. Number of options remains same. Means even though you are not able to achieve the market condition as per Ind AS 102 to calculate EB expense, we require two information: number of options, fair value. The number of options will remain same even though market condition is not satisfied. This concept I hope you remember. Got it? Service condition to remain service until market condition meet. So till market condition meet, employee need to remain in the service. Means we don't know what is the vesting period. Therefore we need to estimate the vesting period for what? For this entire EB expense recognition. So management has expected that market condition will be achieved in 4 years. Means as per management, can I say the intention is to retain the employee for 4 years, and if they can retain the employee for 4 years, their objective is fulfilled. Got it? Yes sir. So define expense related to SBP in each of the years subject to the two scenario कि market condition was satisfied in year 3 or market condition was satisfied in year 5. So they have given two scenario. First, market condition has been satisfied in 3 years. We are doing question number 8. Correct? So first case 1 is what? Market condition was satisfied in 3 years. Now what will be the expense of year 1, year 2, year 3, year 4? Because we expect that it will be satisfied in 4th year, but it was satisfied before 4th year. Correct? That we need to understand. So can I say what is given? How many options they have given? 100 employee they have given. Number of options per employee is not given, so we'll assume number of options per employee is 1 only. So 100 employees, 100 options will be there. Into fair value 25, then we'll do 1 by 4. Because initially we don't know what is the actual, so we'll take estimated only to 4 year. So it will be 625 cumulative expense, and expense will be also 625. Second year, second year also will do 100 into 25 into what? 2 by 4. So it will be 1250 and then 625. Correct now? Correct. I think first year and second year no doubt. In this, so you would have also done in this way only. Correct? It is 1250 and 625. Now third year condition is satisfied. So can I say third year condition is satisfied? So entire benefit received, if entire benefit received, so it will recognize entire expense in 30 only. Understood point? It is 100 into 25. You can say 3 by 3 because now actual vesting period is 3. Got it? So it will be how much? 2500, and out of 2500 how much already recognized? 1250. So 1250 will be the expense of third year, and no expense will recognize in year 4. I hope this 2 is very simple. This you could have done by your own. Now case 2 is important. Case 2, if market condition was actually satisfied in year 5. Understood? So what we'll do, how much expense we recognize in year 1, year 2, year 3, year 4, year 5. Yeah, there is no doubt about year 1, 2, 3. Year 1, 2, 3, no doubt. Can I say year 1 will do 100 into 25 into 1 by 4. It will be 625. It will be 625. Year 2 also will do the same. 100 into 25 into 2 by 4. It will be 1250. It will be 625. Year 3, sorry. Year 3 also will do the same thing. It will be 100 into 25 into 354, because we don't know the actual vesting period. We'll take estimated vesting period. So it will be how much? 1875, and this will be 625. Now year 4, the doubt will come whether we'll take vesting period as 4 year or we'll take 5 year. Can you see in year 4 we don't know when it will be actually vested. Can you see in year 5 we'll come to know that what is the actual vesting period. Means in year 4 also we don't know about the actual vesting period. So don't take that yes it will be now actually vested in 5 years, to take divide by, we'll say what, we'll do what, 4 by 5. That is not correct. What was the intention? Intention was to get benefit in 4 year, and can I say in 4 year employee was retained, so entire benefit automatically be received in 4 year. So all the expense need to be recognized in 4 year only now. Means will not recognize any expense in 5th year, because what was the objective of this plan? The objective of this plan is to retain the employee for 4 year. And can I say if the employee has retained for 4 year, so entity has received all the benefit. If entity has received all the benefit, so can I say all the expense will be recognized in year 4 only. Therefore in this case we'll do 100 into 25 into 4 by 4, and this will be 2500, and this will be 625, and for year 5 no expense will be recognized, even though SAR is not yet vested. Can I SAR will be vested, sorry, this is not SAR, this ESOP will be vested only when the market condition is satisfied. Are you getting? If market condition is satisfied, then only it will vested. Means we recognize all the expense, but employees are entitled to equity shares only when market condition is satisfied. Means can I say this will remain as SBP reserve till market condition is satisfied. Once the market condition is satisfied, we'll allot equity share, and suppose employee left before market condition is satisfied, then this option will be automatically cancelled, and then we'll do SBP reserve to retain earning. Got it? Have you understood this entire? So this question may come in exam, which I think requires some attention. I don't know, because there are many type of question, all types of question have been asked in exam. This particular question has not been asked in exam, and one question related to group SBP share based plan, that question has not been asked in exam. Apart from that, all types of question has been already asked in exam. So from my point of view, these were the expected question which may ask in exam from this chapter. I hope you have understood. Have you understood all the questions? Now if you have any other question which is in your mind, correct now, so that you need to inform me, then I will once again come back for that question. Tomorrow we'll take we can take which chapter? We can take financial instrument chapter. So tomorrow we'll do financial instrument chapter. Chalega? So if you have any question in mind, you can update that question in the Telegram group. The link of Telegram group has been given in the description of this video, so you can join that Telegram group. Correct? You can join one revision group also. I have created one FR revision group for May 2023 attempt. So you can join there. You can just inform me, sir, this is a question which is not included in the expected question, and that question you want me to do in this live video session. So I will consider that question also. We'll do explanation of that question also. But I hope whatever question is given in expected question is that to pakka I will do. Got it? Yes, sir. Thank you very much for today. We'll meet once again. We'll meet tomorrow with another live YouTube video session. Correct? I hope you have understood entire thing. Let's meet tomorrow again. Bye bye. Take care.